All right. Good morning, good afternoon, traders. Today is Friday, September 19th, 2025. This is You've Got Options for Income Navigator. We're going to start off with a position that has been on for about 32 days. This is a synthetic short position in VXX. This position was introduced about a month ago. Today, we had a short put that was expiring on September 19th. Short put was at 33 strike. I closed out this put earlier today. VXX was kind of trading lower, and now it's slightly higher in the day, so not here nor there, but this is what this position would look like if I didn't buy to close the short put. In hindsight, was this something that made this trade much better? Not really. I initiated this trade when VXX was trading at around 38. I collected a small credit for buying an at the money put and selling an at the money call at 38 strike. And this one has a long time until expiration. Right now, after 30 days, 32 days in the trade, this synthetic short still has 483 days. This is January expiration in 2027. And what I ended up doing with VXX trading at around, I think it was at around 36-ish, I went ahead and I sold a 33 put for today's expiration. I think this was August 22nd. So about a little bit less than, so 3 weeks out. And I sold that put for 45 cents. And, right now it's trading for about, 6 or 7 cents. But earlier today it was trading, on yesterday's close, it was trading at 65 cents. So it was at a loss of about 20 cents or $20 for the one contract. And then when the market opened this morning, I went ahead and I closed it for 30-cent debit. So essentially I made $15 on this lousy one lot. And the goal now is to continue to hold this synthetic short in VXX. And last week we talked about, what this trade is, how it works, why would we want to consider a trade like this. If you haven't seen it, this is posted on Discord. You can go ahead and check out that video. But the goal is to hold this trade for as long as possible. There's no profit target per se, right? We can trade around a core position. Real quick, as I mentioned before, the goal for this trade is, right, when VXX, there are going to be times when VXX is going to see a spike, right? Volatility is going to spike. Front month VIX future contract is going to be way higher than the back month, which will cause VXX to increase in price, which means that this synthetic short isn't going to be fun to hold. But the key is to be able to improve cost basis over time. So if I took a short position in VXX or synthetic short position in VXX at around 38, I wouldn't want to go all in at 38. Now, I don't know, this thing could go to 10 before it goes back to 40. And if that's the case, then, it is what it is. I can't control it. But if it goes to 40, or if it goes to 50, or if it goes to 60 or 90, right, the goal is to add more to the synthetic short position using at the money options. And eventually, right, this is my personal opinion, eventually, when volatility is going to mean revert, and I think that we're going to be in contango, which means front month is lower in price than the back month. We're talking about VIX futures contract. VXX is going to grind lower over very long periods of time. So we're going to use these spikes in price of VXX to potentially improve our cost basis. And if right now my upside break even is at around $39.45. If I added more at 50 and I added more maybe at 70 or at 90, right, eventually I would probably work my cost to somewhere around, maybe low to mid 60s. And then when it goes to 30 or 32 or 35, right? If I had already had, let's say, maybe three tranches on, and my upside break even was somewhere, let's say $60, right? Now trading at 33, maybe I would reduce, right, 2/3 of my position. Meaning if I had three tranches on, I would get rid of two of them, essentially lock in profits, hold on to one with an assumption that at some point in time, we know it, or we have to assume that at some point there's going to be a spike in volatility. And if that is the case, that is our signal to go ahead and add more size. So we may have a core position of maybe two tranches, and then we have a plan to increase our overall position to as many as five tranches, right? But the two are core, and the other three, we're just going to trade those three tranches around our core position. Hopefully this makes sense. If it doesn't, it's okay. Hopefully we get to show you exactly how this is done. So this is a one lot, it's a starter position. Would I add this position on every Monday, every Friday? Absolutely not, right? I would hold it. And then if volatility is going to spike, if VXX is going to be, at quote unquote extreme levels, then I will consider adding to this position. If not, I'm just going to hold it. And if VXX is going to grind its way down towards zero, well, upside potential or profit potential for this trade is limited because this POS can only go to zero. So if I'm short this thing at 38, the most, if I cover everything and everything is at zero, then my short 38 call is worth nothing, and my long 38 put is worth 38 points. So the most this can possibly make is $3,800. I don't think it's going to zero. I think if this ETF or ETN is going to grind lower, they will probably reverse split it when it gets to around $10. Based on what they have been doing so far, anytime it goes into low double digits, they do a 4-for-1 reverse split. Essentially, when it gets to 10, they do a reverse split, putting it back to $40, and then as it grinds back down towards 10, they do another reverse split. And I think that we're not there yet, but I would be looking for some kind of a reverse split if and when we get down to about $10 per share. Another question I had about selling puts on this. I don't think that selling puts is super attractive. I mean, sure, you can bring in some additional premium, but where are we selling these puts? If we're trading at 33 and we think that over long periods of time, as long as the market isn't doing something crazy, if the market is pretty stable, I think this thing is going to grind lower. So there's not a whole lot of premium that's available to the downside. Maybe selling a 28 put, right? About what is it, 5 points out of the money. Selling a 28 put, we do potentially give up some of the profit potential on the downside. We're collecting another $90 or something like that in premium. It does, take off some of the directional exposure or delta, right? Without this short put, we're at minus 98 delta. Selling a 19 delta put will cut this position by about 20 delta. So we go from about minus 100 to about minus 80. It doesn't make a big, big difference here. Maybe over time, if we can bring in about $80 every 40 days, by the time this thing goes to zero, maybe it'll make a difference. But it's not something that's going to make or break this trade. What's going to make this trade great is volatility spikes, being able to add to this position when that happens, and cover parts of this position when volatility mean reverts, that is where this trade really is going to make most, if not all, of its profit. Hopefully this is clear, guys. If not, no worries. Please feel free to ask questions. So that's VXX. Short SPY put campaign. I mean, I think it's pretty straightforward. Let me see if I can pull up the spreadsheet, and I did share the spreadsheet that I use, or I shared a template that I use. I'm going to hop on over to this spreadsheet now, and I had some questions, and those are all great questions, right? Like, how many tranches will you hold? I think that's a great question. We did talk about short SPY put campaign, and there isn't one way of doing this trade. You have to understand your notional risk or your leverage that you're using in your account. You have to have a plan what you're going to do, if anything, should your naked puts go in the money. If you don't plan on getting assigned, right, you probably don't want to wait until your naked puts go in the money, because rolling or adjusting your position is just going to be a little bit more difficult, right? If you're buying to close a put that is in the money, right, and now it's starting to increase in intrinsic value, so you're paying intrinsic, and you're trying to roll it to out of the money, where that option that is out of the money has no intrinsic value, right? That roll becomes a debit. So if you're going to collect the credit and then you're forced to pay a higher debit to make an adjustment, you're potentially extending your duration, right? So you're extending your risk, but instead of getting paid for it, you have to pay for it. Doesn't make sense to me. So I would plan on making adjustments sooner rather than later, or use stops if getting assigned is out of the question. You also want to understand, right? For example, so on this spreadsheet, I have a column that keeps track of notional value. So right now, between these 7 trades that I have open, total notional value is about $430,000. And you can say, okay, so if I'm holding $430,000 and I'm doing this in a $200,000 account, your notional leverage is about just over 2 to 1, right? So which is, it's not super duper risky, but you have to understand that once you start to go beyond, 3x notional leverage, it could potentially become a problem. One other way I put on this spreadsheet, and again, this is not something that is, black and white. You kind of want to understand, what these numbers mean and how you are as far as your, risk profile, comfort level goes. But you need to understand that, for example, if you're not willing to take an assignment on any of the tranches, you took in X amount of credit, right? I have here, this is what 50% profit target debit price looks like, right? So for example, today I sold a 620 put with 70 days until expiration. I collected $5.30. So 50% profit target will be a debit of $265. If I'm going to stop out, I'm going to pay $16.35. If I get stopped out of this 620 put, right, this is going to result in a loss, right? This is per one contract of about $1,105. So every single tranche that I have on, I know that if I stop out, there's going to be a loss of X. This is going to be a loss of whatever, right? And then I combine them all together. So for example, if I'm not going to take assignment on any of these tranches, if I'm going to stop out on all of them, you could say, well, what kind of a market move do you need to see in order, to get stopped out on all of them? Probably a limit down on Monday with a pretty good volatility spike even though it may be just temporary, but I think that that's going to jack the premiums way higher, and there's a good chance I may hit a stop on all of them if I don't plan on taking an assignment. Which what that means is that if that is the case, it's not very likely, but if that is the case, right, if I stop out on all seven of these tranches, I am potentially looking at a loss of $7,427. Now, regardless of what your account size is, regardless of whatever you use, 2% per trade, 3%, 10% per trade, whatever you may hear, what you should use for a stop loss. These are just numbers that someone's talking about. You want to ask yourself, what kind of a loss are you comfortable with? If you're not comfortable with $1,000 loss and you have seven trades on, if they all hit, you're out $7,500. If this is the kind of loss that's going to keep you up at night, then you should not be holding seven tranches. I don't care if you have a $5 million account. If you're not okay with this number, right, you cannot hold this many tranches. I'm not saying it's a lot or it isn't. I'm just saying that you need to know you before you go on and follow anybody or you follow anybody else's trading system, right? You also want to understand, what does this number represent, right? So if you're doing this in a $200,000 account, $200,000 account, right, did I get that right? Hang on, I think I got that wrong. 200,000. Uh, Sorry, not R49. This is R62. So if we were to hit $7,427 loss in a $200,000 account, this would represent about a 3.71% loss of net lick, right? So maybe you're not comfortable with the dollar amount, and that's not, there's nothing wrong with you. You need to work your way up to it, right? So once you get to size, or you can put on, let's say instead of seven tranches, you use three tranches, you stay there for maybe 3-4 months, and then you add one more into rotation. At some point in time, you will be used to the idea that, potentially getting stopped out on all seven is very unlikely, but it could happen. So, and if that happens, if it's going to take back, 4% of your account, it's not that big a deal, assuming you have a decent trading plan and you're going to be able to recover from this. But if you're doing this in a $50,000 account, right, and an aggressive stop on all seven tranches here will result in a 15% net lick loss, right? Now you have to think about, like, in order to make up 15% of your account, right? What kind of return do you need? This is the number you really need to be concerned with, right? I think that in a $200,000 account, using a 2 or 3x notional leverage, assuming stops and all trades, is not a terrible idea, or it's not a terrible way to manage your risk. But as maybe as an example, you want to use something along the lines of, I'm going to use notional leverage in my account to increase my potential returns, and we'll talk about that in just a second. I'm going to use some leverage, right? So maybe you'll go 2, maybe 2.5, maybe as much as 3x notional leverage. But if things start to get really shaky, if the market starts to roll over, you may say something along the lines of, I cannot take all of these, right? I have a $200,000 account, but if I cannot take assignment on all seven of these tranches, because that would take $428,300 to do so, right? So you say, I'm going to take assignment maybe on the first three, That'll take $182,000, right? And then on the other four, I will have to use stops. And then on those shares that you get assigned, you have a plan to sell covered calls, assuming you can sell a covered call above your cost basis and potentially get yourself out of that position by getting called away, right? So it's kind of a hybrid. You're using partial stops on some of the tranches. You're committed to taking shares on some of the tranches, right? But you have to know all of these things beforehand. Okay, so that's the idea behind this trade. I think I don't remember who it was, but somebody asked earlier today about how many tranches we're holding, and these numbers here, they are going to change over time. But for right now, what it looks like, an average days in the trade is 17. So we have to assume that 17 days in the trade. This is about 3 weeks, right? So trades usually last about 3 weeks. So if I'm taking trades off, if I start to put on trades today, I would expect to start to take trades off in about 3 weeks from now. Between now and 3 weeks from now, right, there will be about 9 new trades put on. So if I start today with trade one, and the first trade does not come off for 3 weeks from now, that means between now and then, I would probably put on about 9 trades, because I put these trades on Mondays, Wednesdays, Fridays. That's 3 times a week times 3 weeks. That's 9, right? So we have to assume that we'll have about 9 tranches in rotation. Again, now you want to go back and say, if I have 9 tranches, what does my total notional look like? What is that notional value to my net lick? What kind of leverage am I taking? If I get stopped out on all 9 positions, how much of a loss am I taking? You know what I mean? So you have to think about all of these things beforehand. Maybe you can't hold all 9. Maybe you say, you know what, I'm going to go with only 5 tranches, even though the first trade isn't going to come off for about 3 weeks. You put on 5 trades, and then you stop putting on new trades until some of the older trades start to come off, right? So, but you have to understand your numbers. I can't tell you what to do. No one can tell you what to do. So, do what is best for you. But let's talk about for just a second, what kind of returns, or again, it's kind of hard to measure returns because it takes very little margin to put these on, right? An average position takes up about $5,000 or $6,000 in the portfolio margin account. Is that all of my risk? It isn't, because that margin could potentially increase, right? If the underlying starts to go down and the broker is going to ask us to put up more money, that margin or buying power requirement is dynamic, right? It's not static. So we don't really know exactly what are we measuring as far as risk goes. One thing that does not really change is your starting net lick, right? So let's say we're doing this, in a $200,000 account. So far, and again, this number isn't, something that you should make all of your decisions based on, but so far in the month of September, and we can take, each and every month and then kind of average some sort of a number to get a better idea. Because, sometimes if you don't have any trades come off and then the market starts to finally move higher, or volatility finally comes in, all of a sudden you have a bunch of trades that are coming off. So in this example, right, so we had a bunch of exits on September 5th, 9th, 10th, 11th, 12th, right? On 12th, we had a bunch of trades come off. On the 15th, we had a trade come off. So far this month, and we're, about 20 days in, there were 9 trades that came off. And if we look at the P&L, the total P&L for these 9 trades is about $2,400. Okay, so next step, you say, all right, if I'm going to make about $2,400, and granted, right, no losses so far, will there be losses? I bet there will be, right? But if you make $2,400 in a month times 12, that's 28,800 in 12 months. Divide that by we're doing this in a context of a $200,000 account. It's about a 14, 15% return on right overall account. If you're also holding some treasuries, they're maybe paying you 4% on top, right? So you're getting a decent return. This isn't something that it's going to make you the number one hedge fund manager out there, but you'll probably beat long-term S&P 500 returns doing something like this. I know that we've been very spoiled and the market's been going up 20% here, 30% there, but this isn't. I don't think that kind of rate of return is going to last forever. Long-term S&P numbers are something like 11 or 12% year over year. So are we going to revert back to the mean? I think so. But if you can do something like this does not require a whole lot of effort. It does take some risk potentially to take. But if you can squeeze between 15, 18, 20% doing something as simple as this, I don't think this is a terrible way to generate returns without having to sit in front of your computer all day. And we could also go back and say, all right, we've been doing this since May. Granted, since May the market did nothing but go up, and the market doesn't have to only go up. As long as we're not seeing a really nasty, whipsaw in the markets, up 20%, down 20%. Even in 2022, we were using a slightly different variation of this trade. And in 2022, you can see that, 2022 was a down year. Sure, there were some losses in the beginning of the year, but then we went on. Even as the market was coming down, right, implied volatility was rich enough, right, for us to be able to squeeze out, whatever we were making on these very far out of the money short puts. And as you can see, as the year went on, there have been no losses. There were no losses until like 2024, right? So a down market doesn't really scare us as much, as long as it's not, COVID type of action, every 6 months. Then we potentially have a problem and may need to do something different or make some sort of an adjustment. But for, let's say, so far in this strategy, since May, this is end of May, so let's call this 4 months, right? If it's up $11,600 or so, so let's round this off to 11.5 over 4 months. That's $28.75 a month times 12. It's about $34,000 a year. If we're doing this in a $200,000 account, it's about 17.25%. So, and these numbers aren't something that it's too good to be true. I think these are very realistic. I don't think that these numbers are super misleading in any way, shape, or form. However, if and when they do change, we'll keep you guys posted. And if we find something else that works maybe better, more efficient, or whatever, then we'll consider, and we'll most definitely are going to tell everybody about it. All right, so that's what I have for this short SPY put campaign. Let me go back for just a second and see if there are any questions so that I'm not moving on from thing to thing and not looking at the questions. Do I use an early profit target for the short put campaign? So this short put campaign is a 50% profit target. If, let's say, there were times, you can see there's some 49, 48, 49%, 46, 44, right? If I'm starting to accumulate positions and now I'm, getting somewhere close to, 10 tranches in, and I kind of just want to keep things moving. If I'm sitting at 46%, I can choose to put on another position, and this thing has been just sitting at, between 42 and 47% for the past week. I mean, what am I waiting for? I'm waiting for an extra, again, these are, like one lots. I'm waiting for an additional $20, $30. I would take it off a little bit earlier, right? So I don't quite always hit 50%. And sometimes, if the market is just moving easy, I don't have a whole lot of tranches going on, I may hold it for a little bit longer, but 50% is kind of a guideline. So if I get around 50% and I want to, just keep things moving, I may get out at 46% and put something new on. Question: how is that 7 open trades only? It's 3 a week times 4 weeks. That's 12 trades. Should be open at one time. Again, sometimes the old tranches will come off, like you will get 2 or 3 come off on the same day. So it's not like, oh, every trade is going to come off at exactly 17 days from now or something like that, right? This is just an average number. So sometimes you could accumulate, 12 tranches, and then come Monday, volatility falls because there's some good news in the market, and the market, rallies a little bit. You get 3 positions come off. You went from 12 to 9, plus you added 1. Now you're at 10. So you added a position, and you still net 2 less positions than you were on the Friday going into the next week. So it doesn't always work the number, and I don't really care, to be honest, as much. Oh, I need to have 12 tranches. I'm just going to put on new trades. Some days, if I'm not around or if I'm busy or whatever the case may be, I may forget to put on a trade on a Monday, right? I don't have a robot that's running this trading. I do everything manually here, and if I don't put on the trade, then maybe I'll put it on Tuesday, or maybe I'll just wait until Wednesday and I'll just have one less tranche going in. Maybe the market looks a little bit too heavy for me and I'm not willing to put on any more tranches. So don't just say, oh, you have to have X. You have to do what is right for you. But, on average, you're probably going to have somewhere around 10 tranches in rotation. Again, I don't know how you did the math. It's 3 trades a week times 4 weeks. If you have average DIT days in the trade at 17, right? These are 17 calendar days. That's about 3 weeks. In 3 weeks, you're putting on, right? So 3 weeks times 3 trades a week, that's 9 trades. So assuming that this number 17 holds, right? Your older trades are coming off at about 3 weeks after you put them on. So you have a 3-week cycle going on, something like that. I could have used the 617 strike for today's trade expiring for $5. Was there any reason you wanted with the highest? I like to go with these round numbers: 615, 620, 625, 610, or whatever. If I already have something on there, it doesn't matter. I went for, I could have used the 617 for 5, or I used the 620 for 530. It makes no difference. If the market's going to go anywhere near that, those 3 points in SPY, which is 30 points in SPX, they're not going to make a big difference. I would rather trade a little bit closer to at the money and take a higher credit than, potentially give up, $38 in premium, but put myself, 30 points farther out in SPX. Those 30 points mean absolutely nothing. So I would rather do 620 for 538. And if we go and look at the average credit, it's 535. So sometimes I'll take, 520, sometimes I'll take 430, depending on what is going on. But, average credit so far is around $5.35 or something like that. I think I already answered 12 trades versus 9 trades. Is this all your own trades since 2022? So going back to these trades, yes, these are all, this is not a back test. This is not, some made up numbers. These are actual trades going back to 2021, October 2021. And these are the numbers. I've shared this before. And this is a slightly different campaign where I was selling farther out of the money options for about $1.20, $1.25. And you can see average credit here was $1.35. Average winner was about $1. So I would open it for $1.34 and I would close it for $1.05. Had a 95% win rate. There were 478 winners. There were 25 losers. Running P&L at the time. So this is from 2021 to 2020, May 2025. Running P&L was 40,000. It was a lot of trades, but these were slower trades. Days in the trade was 33. Average days until expiration was 65. There were 25 losers. So, and these losses definitely offset the running P&L. But overall, through ups and downs, this has been a net profitable trade. There was no point where this thing was going to pose a risk of potential no return. So, I mean, again, the reason why, right, we went from $1.20 credit to $5 credit, because I think it makes a little bit more sense. I like those better. I like those numbers a little bit better. And as soon as I find something that works better for me, it doesn't mean that you need to change whatever you're doing. You do what works best for you. But if I think I found something that maybe works a little bit better, I will share it with everyone. I'll let you guys know what I'm doing, and you do whatever you want with that information. Um, New member joined 10 minutes late. Where can I find the trade plan for this trade and this log? So I have a video, maybe several videos on the short SPY put campaign that is in the Discord. You have to use the search function, or you can just go to, I believe they are in my resources, and you can search resources. There's also I'll share a link to that video on in Discord when we're done with this call. Max leverage on $200,000 account. If all positions are open, how much would that be? Again, leverage, as far as leverage goes, we're talking about notional leverage. Look, one short put in SPY in a portfolio margin account will only take up about $5,000 or $6,000. Does that mean that in a $200,000 account you should hold 40 naked puts and max out your buying power? The answer is no, because, well, just simple math here. If, let's say, your average, let me go back to this spreadsheet and let's talk about for a second. Let's talk about strike. So right now, positions that I have open, and as market goes higher, the strike price of the puts that we're using is going to increase, which means that notional value of each contract is going to increase as well, right? But for right now, right, my average price for this SPY naked put is about 611. Let's call this 612. So 612 times 100 shares, right? I have an average notional value of these contracts about $61,200. If we used our $200,000 account and went, full speed ahead with the leverage and opened up maybe 30 puts, right? Because they only take $5,000 or $6,000 to open each one. So we do 61,200 times 30. That's $1.8 million notional in a $200,000 account, right? We're getting almost 10 to 1 notional leverage. What that means, getting assigned on all 30 puts is probably not it's very unlikely, but the leverage, the multiple of total notional to your net liquid value of your account just tells you, right, how much leverage you're taking on. And the higher that leverage is, the less room for any kind of error you have. I think going beyond 3x leverage, you're going to start to run into some problems. Again, maybe you just need to rewatch this video when it's posted, but we talked about stop loss. If you take a stop on any one of these tranches, what that will result as far as your P&L goes, and then how you can measure that loss to your overall account. You just don't want to put yourself in a position where you get stopped out on a bunch of trades, you lost half of your account, right? Because then you need to double just to get back to break even. That's a terrible business model. Right. So if you missed it, or maybe if I'm not making any sense right now, watch the replay. Hopefully this will clear things up. How do you manage SPY falls dramatically like April 2025? Do you take assignment or close? You get stops, or you take assignment, whichever works best for you. I did not get assigned on any of the shares in April. I did not get assigned on any of the shares last year in August because the recovery was pretty aggressive and there were no assignments. There was one time, and this was probably in 2022, where I had several tranches that I committed to taking assignment on, and all of them expired out of the money except for one. There was one tranche that expired. They pinned the price of SPY right on the strike. And then even after the market closed on that Friday, SPY was trading slightly below the strike price, which put my put in the money. But come Monday, there was no assignment. Maybe whoever was holding that put instructed their broker just to let it run out and not assign, for whatever reason. So there has been no assignment so far. Another question, is there any specific time of the day you want? No, there is no specific time. If we sit there and try to time things perfectly, we're just going to go deeper and deeper into the rabbit hole of thinking that the market has something personal against me, you, and everybody else. It doesn't matter. I would rather take care of the business first thing in the morning. So this way, you're free to do whatever. You could do a Zoom call, you could do meetings, you can go play with your grandkids if you like. But take care of things in the morning. You should know exactly what you have to do. At least on the morning of, if not, the night before, you know exactly what you need to take care of. When the market opens, take care of your business. This way, you're not scrambling last minute trying to do things that you were supposed to do. Hopefully that makes sense as well. Do I keep it simple by just open an account, do only this trade in that account and no other trades? I think that keeping accounts separate is not a terrible idea, especially if you're going to do, I think what makes sense for this short SPY put campaign, if you wanted to run this together with treasuries, right? You can hold treasuries. I mean, rates are coming down. We know it. Right now, the rates are somewhere around 4%. I haven't looked at the auction in the recent couple of days, but last time I bought treasuries, they were at like 4.3% or something like that. And these are like 8-week auctions that I do. So every 2 months I go and I buy treasuries. And so if you're going to run this trade and you're going to overlay this with treasuries, meaning that the monies that you have set aside in case you're going to take an assignment, that money is not sitting in the money market, right? Which I don't think, Schwab, unless you put it in a specifically, high yielding ETF or whatever money market fund that they offer, if you just let it sit in cash, they're not going to pay you much, right? So instead, you can choose to buy treasuries, short-term treasuries. They're still paying around 4%. And in the event that you get assigned and you need to free up money, you just have to sell the treasuries, use the money to take assignment of the shares. So this way, while you're trading SPY, right, and you're trading you're selling these puts naked, they're cash secured, but the cash is not sitting in the money market fund. It's sitting in short-term treasuries. So you're collecting income from short-term treasuries. You're collecting income from the short naked puts. And in the event you get assigned, you have to sell some of the treasuries to free up the money for the assignment. All 200K in T-bills, however you want to do it. I can't tell you what to do. But if you're going to set aside, say, a $200,000 account, treasury bills are they're $1,000 face value. Well, they come due or they mature at $1,000 face value. So in a $200,000 account, you'll be buying 200 treasuries, and then you just roll them over. Or there are many ways you can do the treasury ladder. We talked about this before. If you just go and Discord, there's a ton of information, guys. Please use the search function. go and type in the search, the treasuries or treasury ladder or whatever. You'll get a bunch of information. There's a ton. So you can, do 100, 4 week, 100, 8 week, and then as one matures, you just roll them over. So this way you get a blend of rates if rates are coming down or rising aggressively. But Charles Schwab, they give you back 99% of your buying power if you do it in a short-term treasuries. So if you put in $200,000, you'll get $198,000 in buying power, not cash. You can't use that money to buy anything else, but you can use that as a buying power requirement to sell SPY puts, SPX, anything but a futures options, anything that does not use span margin, right? Because span margin is a completely different account. So if you do that, and this is one of the reasons why I would say, keep things separate, because if you're running your futures together with your equity or index options and you have a bunch of treasuries, your span margin is going to draw from available cash in your account. So if you don't account for that ahead of time, you can potentially put yourself in the position where you're out of cash and you will get a margin call. All right, let's move on. What else we got? Let's talk about. I have one more position that is going to expire today. Bear with me. And I will add, I'm going to add a SPX, the original bear trap trade, which is a defined risk trade. Let me just switch over my screen and we can talk about this trade. So this is what we got on for September 19th. We don't need to do anything. I'm just waiting for this thing to run out, and it's going to run out at the end of today. All options that are part of this trade are out of the money. So we have the put debit spread that's worth 0. So I can't sell it for anything. It's worth nothing. But our short put credit spread is also worth 0. So I don't need to buy to close this put credit spread. So they're all going to expire for 0. I'm just going to keep the original credit, which was $200. So looking to set up similar trade. We've done this before. For those that have not seen the video, again, you can go on Discord and type in OG bear trap. Or you can go and you can look at this trade. This trade ID is 3226. If you go to the section where I post my trades, type in 3226, you will get the post that I create for when I take a trade. For this specific trade, you'll see exact setup, and you can also ask questions related to any specific trade on that trade post. I just ask that you guys stay on topic of that trade. If you want to talk about something general, then you should probably create a new topic in the forum instead. But the idea behind this trade, and we can go and I have skipped 2 potential trades in SPX. I instead traded a calendar just recently. We closed that out, and I had an iron condor that I was stopped out for a loss, and I was traveling, so I just didn't want to continue to put things on while I was on the road. And now I'm going to once again continue to add and potentially build a new ladder with these bear traps, right? So the idea is to put these trades on every other week, right? So today, the 19th, the next one isn't going to go until about October 3rd. or the week of October 3rd. The idea is pretty simple. We're going to use options that have 42 days until expiration. And you're going to ask me why 42, and I'm going to tell you that if we take 42 and we divide that by 14, we get 3, which means there are going to be 3 trades in this cycle. We're going to run a 3-trade cycle. I put one on today, I put one on 14 days from now, and I put one more on another 14 days after that. When it's time to put on another one, my first one that I'm putting on today is going to be coming to expiration. So there are going to be 3 trades in a cycle, assuming we hold all trades until expiration. The idea is pretty simple. And as far as campaign trading goes, I don't want to break the cycle. I want to put on this trade every 14 days. The difference between these trades, they don't all have to start off with a net credit, with positive delta. We get to decide and choose, right, how we want to start off a trade. If you're looking at the chart and something tells you we're overbought for whatever reason, and you don't want to start off, or maybe you already have a bunch of positive delta elsewhere in your account, you just don't want to add another trade with more positive delta in SPX, you can start off a trade with negative delta. You can start off a trade with neutral delta or directional exposure. And I'll show you what that would potentially look like. We would probably go out. So we're looking for 2 spreads, a put credit spread and a put debit spread. Let's start off with a put credit spread. We're probably going to go and look for something around delta, maybe 15, right? We can go and look at, let's see, we're selling 68.85, and then we're going to go out 50 points on SPX. So that's 10, 20, 30, 40, 50. So 62.35 is the long leg. And we're looking for a 50 wide, which is what this is, 50 wide for a credit of around $4. This one is going for $4.40, so it's a little bit too much. Let's see if we go down 5 points. Will that change the price of this spread by much? Now it's at 4.30. We can go down maybe another 10 points. Right, we want to go as far out of the money on this put spread as possible. All right, so this one's going for about 4.20. It's not terrible, right? We can probably go down another 10 points. But let's just assume that this is what we're going to use. So we're selling to open 62.70, 62.20. That's a 50-point wide put credit spread for $4.20. Now we're going to go up, and we're going to look for a 10, potentially 10, maybe 15-point wide debit spread. So if we wanted to start with a relatively flat position, right? This position has a net delta of slightly less than 1, right? Which means that for every 1 SPX point move, right, we're going to make or lose just about $1. Right, so not a whole lot of directional risk to start with. If we wanted to be a little bit more bullish, instead of using a 10-point wide spread, we'll use a 5-point wide spread, which means that we're spending less on this debit spread. All right, remember, we're collecting $4.20 on the put spread. We're spending some of that on this debit spread. So if we spend less, that means we get to keep more, which means the net credit to start is higher, which is the good thing. The flip side of that coin is that if we start off with a higher credit, we're also taking on 2 times as much of directional exposure, right? It's still not a whole lot. It's only plus 1.32, but if SPX starts to pull back, right, because we're short gamma, our exposure is going to work against us and our delta is going to increase on the way down. So if you wanted to start off with completely flat delta or close to zero, right, you go 15 wide, you go 20 wide, whatever works for you, right? This is a 15 wide debit spread, so we're spending more. We take less up front, right? We take less up front, which is kind of bad, right? We don't want to take no credit or even pay a debit. But in exchange for that, we get no directional exposure, which means that if Monday the market is down, 40 handles, it doesn't really affect us too much because we don't have any directional risk, right? So we kind of get to wait and see what happens or which way we move next. If you wanted to start off with a net short delta, right, take a bearish, so to speak, position, not necessarily bearish, but neutral to slightly bearish, then you go a little bit wider on the debit spread and you start off with a negative delta. Now, if the market starts to pull back, you have negative delta, you're probably going to make some money with the delta. You can see that we're also short Vega, not a whole lot, a little bit of short Vega. So if volatility is going to tick up, it potentially could offset some of the gains from your delta. But this position is pretty neutral, right? Up 40 handles, down 40 handles. I wouldn't expect this trade to do a whole lot, right? So this is more like a flat position with no risk to either side to start. And then as the time goes, you can see the 27 days in, if we're still where we are, right, the delta is going to change. If we rally a little bit, the delta is going to change. Now we're, short about 2.5 SPX delta, so we need to figure out what to do because if we paid a small debit to start, if we do nothing, right, we are at risk of losing that initial debit that we're paying, right? If we start off this trade and we paid $1.90, if SPX is going to expire somewhere above, right, the long leg of this debit spread, which is at 62.25, we're going to lose $1.90 or $190 per one lot. So we can't leave this alone. We need to figure out how to recover this initial debit by potentially, rolling some of these options lower or higher. But the point will be to bring in a net credit. Or one more idea, if we wanted to start off a little bit, if we wanted to do a 10-point wide debit spread, but we didn't want to pay as much as we will be paying if we did a 66.25, 66.15, we can go farther out of the money on the debit spread, right? Which means that it's going to be cheaper. So we get to buy 66 or 65.90 and then sell 65.80, right? This is a 10 wide. This is a 10 wide spread for about $1.50. And then if we went even further out of the money on that debit spread, now we get to bring in a credit instead of $1.50, $1.75. Right? And the delta is going to change. The higher the initial credit, the more positive delta you'll have. I don't know which one is right, which one is wrong. There isn't right or wrong. This is because, you have to understand where you are, how much exposure you need to add, if any, and do what is right for you. Right? So for example, if you wanted to start a somewhat of a neutral trade, you can start off with, the way I started the trade that's expiring today, the initial credit was $2, right? So if I put on the trade that looks like this, it's very close to what I had, which means that if the underlying, which is SPX, is somewhere above, it's somewhere above 65 at expiration, right? This is in 42 days from now. The most I can possibly make is the initial credit, which is $1.80 in this case. If we're inside the trap, I'm going to make 10 points or $1,000 from this put debit spread plus the 180, which was 1,000 plus 180 is 1,180. So $1,180 profit potential at expiration inside the trap. All of the risk is to the downside, right? So I would put on something that looks like this, depending on how much delta I needed. I can go a little wider or a little narrower, right? And then all I have to worry about is the downside risk. If the market starts to push deep into the trap early on in the trade, clearly, right, this is a bullish trade no matter how you slice it. If the market is pushing deep into the trap early on in this trade, the easiest thing to do, in my opinion, is to cut the trade and rethink. Maybe something has changed. If we move, down 5% in the next 1 week, the market is definitely not pricing in a 5% move right now. So if we are in fact moving 5% in a week, maybe there's some new information that's available. Some kind of a new catalyst is being introduced in the marketplace, and that's causing the market to move the way it's moving. So this old setup is no longer valid, right? Instead of trying to figure out cute ways to potentially adjust and manage this position, remember, doing any kind of adjustments to this position would be closing partially or all of the old position and opening a new position. So that's why I'm saying if the market or if the underlying pushes deep in the trap early on, something is happening, something has changed, because right now, based on current implied volatility, the market over the next 42 days is pricing in a move somewhere inside of this darker gray area. But if we're pushing way past this darker gray area, obviously volatility, realized volatility is much higher than what was being implied at the time when we take the trade. We need to be aware, what's happening in the marketplace is, is there news? Is there an event? Is there whatever? And I think the easiest thing to do is just to get out of the way, rethink, because you could always put something else back on, right? So instead of scrambling and trying to move pieces around and try to change some things, if we push down into, in this example here, I would probably be out of this trade if it was down about, $500 or $600. Right? I take $200 or I take $1.75 up front, so I know that, most of the time I'm going to be able to make about, 180, which is the initial credit. There may be a chance that I could make a little bit more, right? If we start to build this hump, if you will, whatever you want to call this, right? A little bit of a hump over, but this is 27 days into the future. So maybe I can potentially make a little bit more than what the original credit was. There will be occasional winners where we catch the price in the trap and we'll make a really nice bonus. But most of the time, it's probably going to be just the initial credit. The only one thing we have to worry about is not losing, right, 10x what we normally make or 20x, because the downside risk, this is absolute risk, right? The margin that is required for this trade is at around $3,800. We cannot risk $3,800 trying to make $180, right? It doesn't make any sense. So if we're down $500-$600, I think it's still manageable to recover from such loss. That's why, if we're deep in the trap, we're down, $500-$600. It's time to cut the trade and move on. All right, so that's the trade idea I have, and I'm going to put on this trade. I'm probably going to do 10 wide at 65, 65, 65, 65, 65, 55 for the put debit spread. And on the put credit side, I'm going to go down to 62.70, 62.20. It's currently going for about $1.75. So that's the trade that I'm looking to put on, and then I'm going to do nothing. I'm going to do nothing with this trade until I'm going to hold it for as long as I can and potentially expire this trade out of the money. And then the next tranche for this trade is going to go on in 2 weeks. So 14 days from now, this trade that's currently 42 days until expiration, right? Let's do some simple math. Right now, we're at 42 DTE minus 14. This trade is going to be at 28. I'm going to have another new trade in 2 weeks from now that's going to be at 42. So one trade is going to be 42, one trade is going to be at 28. Another 2 weeks goes by. The first trade, which is what we're looking at today, it's going to be at 14 DTE. The second trade, which we're talking about putting on 2 weeks from now, is going to be at 28 DTE, and the new tranche is going to be at 42. So now we have 3 trades in rotation, and by the time it's time to put on the fourth trade, the first one is going to be expiring. So the second trade is going to replace the first one. The third one is going to replace the second one, and so on and so forth. Hopefully that makes sense. That is the trade. If you want to take a look at where it's going, it's currently going for about $1.75, maybe $1.80. So the way I would do it is I look at the mid price, right? I look at the higher end of the range, right? So we go 175, 180, 185. So I would float the order for maybe $1.90, not expecting it to get filled. It's probably not going to get filled. We're collecting a credit, so we want to stay as high on that number as possible. So if I put an order out for $1.90 and nothing hits, I'll go down a nickel. Now I'm at $1.85. Don't sit on it for 2 weeks and say, man, no one's taking my trade. That's not how it works, right? We go to the market. The market doesn't come to us. We know the range. We know what the theoretical or what the mid price is. We want to get as close to the mid as possible, right? So if nothing at 190, we go down a nickel. Now we're at $1.85. If nothing is there for maybe 5 minutes, maybe whatever, right? I wouldn't wait hours. If nothing is there in the next couple of minutes, maybe 5 minutes, I go down another nickel. At some point, right? And I keep looking at, what is the range? And I'm going to try to get to as close within the mid price as possible. All right, guys. So that's all I have. Hopefully, I gave you something to think about. If you have any questions, please let me know. I'm going to put this thing on, and I'm going to post this on Discord as well. If you have questions, I encourage you to please ask questions. Do not hesitate. It helps us help you. Otherwise, thank you for taking the time. Enjoy the weekend. We'll be back next week. Have a good one. Take care, everybody. Bye-bye.